There's a moment in every monetary system when choices quietly disappear. Not in a dramatic collapse, not with headlines or sirens, but through a sequence of decisions that feel temporary, reasonable, and reversible at the time. And by the time the public senses something is wrong, the system has already crossed a line it cannot step back over. This is the point of no return, and it is the most misunderstood phase in modern finance. Most people believe monetary crises announce themselves clearly. They imagine a single event, hyperinflation, a banking panic, a currency reset. But history shows something far more unsettling. The real danger arrives earlier during a period that looks stable on the surface. Markets still trade, banks still open, wages still arrive on schedule. Yet beneath that normality, the structure that once allowed correction has quietly locked itself in place. This isn't coincidence. It is how large monetary systems fail without immediate collapse. Every functioning monetary order relies on an assumption that errors can be corrected, excess debt can be reduced, bad policy can be reversed, confidence can be restored. The point of no return is reached when those assumptions stop being true. From that moment forward, every policy response only deepens dependence on the very mechanisms that caused the problem. What looks like stabilization is often just postponement purchased at the cost of future freedom. This is where most observers get it wrong. They focus on outcomes instead of process. They ask whether inflation is high or low, whether markets are up or down, whether growth is slowing or accelerating. But those are surface indicators. The deeper question is whether the system still has optionality. Can it tolerate higher interest rates without breaking? Can it reduce debt without triggering collapse? Can trust be restored without force or coercion? Once the answer to those questions becomes no, the system has entered a different phase entirely. This pattern has appeared long before modern central banking and digital finance. It does not depend on ideology or technology. It emerges from the same structural pressures every time: rising obligations, political incentives to delay pain, and institutions designed to smooth shocks rather than absorb them. At first, intervention works. Liquidity calms markets. Guarantees restore confidence. Emergency measures buy time. But each intervention narrows the range of future choices. Each rescue sets a precedent. Each temporary fix becomes permanent infrastructure. The critical danger of this stage is that it feels reassuring. Stability returns just enough to silence dissent. The public interprets calm as success. Policymakers point to avoided disaster as proof of competence. Meanwhile, the system becomes more fragile, not less. Risk concentrates instead of dispersing. Debt rolls forward instead of being resolved. The cost of reversal rises until reversal itself becomes politically and financially impossible. Once this stage begins, the system's primary objective quietly shifts. It no longer aims to restore balance. It aims to prevent recognition. The goal becomes maintaining confidence at all costs, even if that confidence is synthetic. Prices must be supported. Liquidity must be abundant. Losses must be hidden or socialized, not because of conspiracy, but because the alternative is immediate disorder. The system chooses control over correction because correction now implies collapse. This is why the most important changes happen without public debate. Legal frameworks adjust, emergency powers expand, accounting standards bend, asset definitions blur. Each step appears technical, boring, and necessary. Few people notice when thresholds move, when exceptions become rules, when temporary facilities remain long after the crisis they were created for has passed. Yet these are the moments that define whether a monetary system can still turn back. The unsettling truth is that the point of no return does not feel like failure. It feels like management. It feels like professionalism. It feels like adults in the room preventing chaos. That is precisely why it is so dangerous. By the time consequences become visible to everyone, the mechanisms that could have prevented them are already gone. This is not about predicting an imminent crash or assigning blame. It is about recognizing a structural phase that has repeated across empires, currencies, and centuries. The question is not whether stress exists. Stress is always present. The question is whether the system still allows honest resolution, or whether it has crossed into a phase where only delay remains. Understanding that distinction changes how you interpret every signal that follows. It reframes stability as a potential warning rather than a reassurance. It forces a different kind of attention, not to headlines, but to constraints. And it raises a far more uncomfortable question than whether a crisis is coming. The real question is whether the system has already passed the point where choosing a different path is still possible. To understand why the point of no return is so often missed, the first step is to dismantle a deeply ingrained assumption that stability is evidence of health. In modern finance, calm markets are treated as confirmation that policy is working. Low volatility is framed as success. Continued access to credit is interpreted as resilience. But this intuition is backward. In late-stage monetary systems, stability can be a symptom of constraint rather than strength. Healthy systems fluctuate. They absorb losses, reprice risk, and allow failure to occur in contained ways. Volatility within limits is a release valve. It forces adjustment and reveals stress early when correction is still possible. When volatility disappears entirely, it is often because it has been suppressed, not resolved. This is where the reframe begins. The absence of visible crisis does not mean danger has passed. It often means it has been deferred. The dominant narrative tells people to watch for dramatic signals: currency collapse, bank runs, sudden inflation spikes. These events do matter, but they are late indicators. By the time they arrive, the system is already reacting, not deciding. The crucial shift happens earlier when authorities become unwilling to tolerate short-term pain under any circumstances. At that moment, policy stops being about optimization and becomes about preservation. This isn't coincidence. Political and institutional incentives converge at this stage. Leaders are rewarded for avoiding immediate disruption, not for preventing long-term fragility. Central institutions are designed to smooth cycles, not to unwind them. As debts grow and interconnections tighten, even small corrections threaten outsized consequences. The rational response from within the system is to intervene earlier and more aggressively each time. What begins as risk management slowly transforms into dependency. The reframe is recognizing that intervention itself changes the structure of the system. Each rescue teaches markets what will not be allowed to fail. Each guarantee alters behavior. Each suppressed downturn encourages leverage that would have been impossible under normal conditions. Over time, the system trains participants to expect protection and then must provide it to avoid collapse. This feedback loop is subtle, cumulative, and extremely difficult to reverse. Public perception lags behind this shift because daily life continues. People still earn, spend, save, and invest. The currency still functions. Contracts are still honored. From the outside, nothing appears broken. But inside the system, the margin for error shrinks. Policy options narrow. Trade-offs become harsher. The cost of doing nothing rises until action is mandatory, even if every available action worsens the long-term outcome. This pattern has appeared before not as a single doctrine, but as a behavioral constant. Societies consistently mistake delayed consequences for solved problems. They assume that because disaster did not arrive, it has been avoided. In reality, it has often been postponed and amplified. The reframe is accepting that the most dangerous phase of a monetary system is not when it is visibly failing, but when it appears incapable of allowing failure at all. Once this stage begins, traditional signals lose their meaning. Growth no longer indicates strength. Low interest rates no longer reflect confidence. Expanding balance sheets no longer represent stimulus, but necessity. The system is no longer choosing policies freely. It is responding to constraints it has created for itself over time. From the inside, these choices feel unavoidable. From the outside, they appear prudent. In truth, they are often neither. They are the behavior of a system that has traded flexibility for survival. Recognizing this inversion is critical because it changes how every subsequent development should be interpreted. It shifts attention away from surface calm and towards structural rigidity. It forces a reassessment of what stability actually means in a highly leveraged, tightly managed monetary order. And it prepares the ground for understanding how such systems progress step by step toward outcomes that no single decision ever intended, but that the structure itself now makes increasingly unavoidable. To see where the point of no return actually forms, it helps to step back and look at the process as a sequence rather than a single event. Monetary systems do not fail randomly. They progress through recognizable stages, each one narrowing the range of outcomes available to the next. When viewed in isolation, none of these stages appears fatal. When viewed together, the direction becomes difficult to ignore. The first stage is expansion with discipline. Credit grows alongside productivity and debt is broadly serviceable. Losses occur, but they are localized and absorbed without threatening the system as a whole. Corrections are uncomfortable but tolerated. At this stage, confidence is earned, not enforced. The system still has room to self-correct. The second stage begins when expansion outpaces underlying capacity. Debt grows faster than real output, but the imbalance is masked by optimism and innovation. Asset prices rise, creating the perception of wealth. Risk appears low because recent experience has been benign. This is where leverage becomes normalized not as speculation, but as necessity. Growth increasingly depends on continued credit creation rather than organic gains. The third stage arrives when the first major stress test appears. A recession, a financial shock, or a geopolitical disruption exposes fragility that was previously hidden. The response is intervention. Liquidity is injected, rates are lowered, losses are contained, the crisis passes, and the system survives. This moment is often celebrated as proof of resilience. This isn't coincidence. Survival is mistaken for recovery. The fourth stage is where the pattern becomes dangerous. The tools used in the emergency become part of the standard framework. What was once exceptional becomes routine. Markets begin to price an intervention as a permanent feature, risk-taking resumes, but now on the assumption that downside will be limited by policy. Debt does not reset, it rolls forward. Imbalances are preserved, not resolved. The fifth stage is dependency. At this point, the system cannot tolerate withdrawal of support without severe consequences. Interest rates cannot rise meaningfully without threatening solvency somewhere critical. Asset prices cannot fall without destabilizing balance sheets. Fiscal and monetary authorities become locked together, each compensating for constraints imposed by the other. The system still functions, but only under increasingly narrow conditions. This pattern has appeared before across different eras and institutional forms. The specific instruments change, but the sequence remains strikingly consistent. Once this stage begins, choices are no longer evaluated on whether they improve the system, but on whether they prevent immediate breakdown. Long-term costs become secondary to short-term continuity. Policy becomes reactive rather than strategic. The sixth stage is the actual point of no return, though it is rarely recognized as such. It occurs when reversal is technically possible, but politically and socially infeasible. Debt could be reduced, but doing so would cause unacceptable disruption. Currency credibility could be restored, but only through austerity that the public will not accept. At this moment, the system still has theoretical options, but no usable ones. From here on, every path forward relies on maintaining confidence through management rather than correction. The final stage is not collapse itself, but inevitability. Outcomes are no longer determined by debate or preference, but by arithmetic and behavior. Inflation, repression, restructuring, or loss of purchasing power may take different forms, but some form of adjustment becomes unavoidable. The exact timing varies, the direction does not. What makes this sequence so difficult to recognize in real time is that each stage appears justified by circumstances. Each intervention has a rationale. Each delay seems reasonable. No single decision crosses the line alone. The point of no return emerges from accumulation. It is a property of the system as a whole, not the intent of any one actor. Understanding this pattern is essential because it reframes present conditions. It shifts focus away from whether current policy is understandable or popular, and toward whether it increases or reduces future optionality. It forces the question of which stage the system is currently occupying, not in theory, but in practice. And it sets the foundation for examining the mechanisms that lock systems into these paths, even when the risks are widely understood. Once the structure reaches this phase, outcomes are no longer driven by surprise. They are driven by momentum. The system does not fall because no one saw it coming. It falls because too many people saw it too late and discovered that the exits had already narrowed beyond use. To understand why systems become trapped in this sequence, it is necessary to look beneath policy decisions and into the mechanisms that quietly remove freedom of action. These mechanisms are not conspiratorial, they are structural. They arise from incentives, balance sheets, and human behavior interacting over time. At the core is debt. Debt is not inherently destructive, but it is binding. Every obligation created today constrains choices tomorrow. As total debt grows relative to productive capacity, the system becomes increasingly sensitive to interest rates, cash flow disruptions, and confidence shocks. Small changes that once would have been manageable begin to carry outsized consequences. This sensitivity is what forces intervention to start earlier and persist longer. The second mechanism is leverage embedded within institutions. Banks, pension funds, insurers, and governments all operate with assumptions about asset stability and liquidity. When asset prices rise steadily, leverage appears safe. Balance sheets expand. Promises are made based on expected returns. Over time, the system builds a layered dependency on prices not falling. Once this structure is in place, allowing markets to clear naturally would not simply reduce paper wealth. It would break contractual obligations across the system. This is where monetary authorities step in, not out of preference, but necessity. Once a large enough portion of the system depends on stable asset values, price discovery itself becomes a threat. Volatility is no longer a signal to adjust. It is a risk to suppress. This isn't coincidence. The mandate subtly shifts from managing inflation or employment to managing expectations. Confidence becomes a policy variable. Another critical mechanism is time mismatch. Short-term liabilities are funded by long-term assets. Governments roll debt continuously. Financial institutions promise liquidity while holding illiquid assets. As long as trust holds, this mismatch is invisible. When stress appears, it becomes immediately destabilizing. The solution again is intervention. Central banks backstop liquidity. Governments guarantee obligations. Each action reduces immediate risk while increasing long-term dependence. Behavioral reinforcement then locks the system further. Market participants learn what will be protected and act accordingly. Risk migrates toward areas assumed to be supported. Caution is penalized, prudence underperforms. Over time, even conservative actors are forced to adapt or fall behind. The system does not just allow fragility, it incentivizes it. Legal and regulatory structures adjust to accommodate this reality. Emergency measures are formalized, balance sheet expansions are normalized, accounting rules evolve to smooth losses rather than recognize them. None of these changes appear radical in isolation. Together, they alter the operating environment so thoroughly that returning to earlier norms would cause immediate shock. Once this stage begins, policymakers are no longer choosing between good and bad options. They are choosing between bad and worse. Raising rates risks insolvency. Cutting support risks panic. Doing nothing risks slow erosion of trust. Every path forward extracts a cost, but some costs are deferred and less visible than others. Systems almost always choose the path that preserves surface stability, even if it undermines structural integrity. The final locking mechanism is political. Large-scale adjustment requires public consent. It requires accepting losses, reduced consumption, or explicit redistribution. In advanced stages, societies have neither the trust nor cohesion required for such measures. Any attempt to impose them risks backlash that threatens the governing framework itself. At that point, maintaining the system becomes synonymous with maintaining political order. This is how the point of no return solidifies. Not through a single policy mistake, but through the interaction of debt leverage, incentives, and legitimacy. Reversal remains theoretically possible, but practically unreachable. The system continues forward, not because it is optimal, but because it is the only configuration that avoids immediate fracture. Understanding these mechanisms matters because they explain why warnings are ignored and why intelligent actors continue policies they privately know are unsustainable. It is not ignorance, it is constraint. Once those constraints dominate decision-making, outcomes are shaped less by choice and more by momentum that has already been built into the structure itself. History offers uncomfortable clarity on what happens once systems reach this stage. Not because past societies lacked intelligence or warning, but because they faced the same structural limits and made the same constrained choices. The specifics differ, but the logic repeats. In the late Roman Empire, monetary stress did not begin with collapse. It began with gradual debasement. Silver content in coinage declined incrementally, justified each time as a temporary measure to meet military and administrative needs. Markets adapted, prices adjusted, daily life continued. What disappeared was trust in the unit of account. Once confidence shifted from the currency itself to the authority enforcing its use, reversal became impossible without dismantling the fiscal structure of the empire. This pattern has appeared before not as a moral failure, but as an arithmetic one. Centuries later, early modern European states followed a similar path. As warfare grew more expensive and taxation reached political limits, sovereigns relied increasingly on borrowing and monetary manipulation. Defaults were avoided, not through repayment, but through restructuring inflation and legal compulsion. Each solution postponed crisis while narrowing future options. By the time credibility collapsed, the damage had already been distributed unevenly and quietly across society. The 20th century provides clearer documentation. In the years leading up to the collapse of the interwar gold standard, governments faced an impossible choice between honoring debt commitments and preserving domestic stability. Maintaining convertibility required austerity that populations would not tolerate. Abandoning it meant redefining money itself. Once that decision was made, returning to the prior system was no longer viable. The point of no return had been crossed, not at the moment of abandonment, but earlier when political tolerance for adjustment disappeared. More recently, late 20th century emerging market crises followed the same structure. Fixed exchange regimes held long after fundamentals no longer supported them. Authorities defended pegs with reserves, controls, and assurances. Stability persisted until it suddenly did not. When adjustment finally came, it was violent precisely because gradual correction had been deferred. The sequence was not hidden. It was simply ignored until arithmetic forced recognition. In each case, the decisive moment was not collapse itself, but the loss of optionality beforehand. Once obligations exceeded the system's ability to absorb loss transparently, authorities shifted toward concealment, compulsion, or redefinition. Money was altered. Contracts were rewritten. Rules were changed midstream. These actions were framed as emergency measures, but they marked a transition from voluntary trust to enforced participation. Once this stage begins, outcomes vary in form but not in nature. Purchasing power erodes. Wealth transfers occur without explicit legislation. Savers subsidize stability. Risk is socialized while gains remain private. The adjustment is real, but it is dispersed over time to reduce resistance. This isn't coincidence. Gradual loss is politically survivable. In a way, sudden loss is not. What history shows most clearly is that systems do not announce when they have crossed the point of no return. They continue to function. Institutions remain intact. Authority appears strong. The break becomes visible only in hindsight when people realize that what they thought were choices were in fact delays. These precedents matter because they remove the illusion that modern complexity offers immunity. Technology changes speed and scale, not structure. Legal sophistication changes presentation, not constraint. The same forces apply whenever obligations outrun productive capacity and political systems refuse early correction. The lesson is not that collapse is inevitable on a fixed timetable. It is that once certain thresholds are crossed, outcomes become constrained to a narrow range. History does not repeat in detail, but it rhymes in mechanism. And those mechanisms do not care whether participants recognize them in time. Applying this pattern to the present requires shifting attention away from predictions and toward constraints. The question is not whether current institutions are competent or well-intentioned. It is whether the system they operate within still allows meaningful reversal. When examined through that lens, several signals become difficult to dismiss. The most obvious is scale. Obligations across public and private sectors have grown to levels that assume persistently favorable conditions. Debt servicing depends on rates remaining within a narrow band. Asset valuations depend on liquidity remaining abundant. Fiscal commitments assume continued access to cheap financing. None of these assumptions are guaranteed, yet all of them are embedded into the system's baseline functioning. Once this stage begins, policy is no longer about optimization. It is about maintaining the conditions those assumptions require. Another signal is policy asymmetry. Support is immediate and forceful when stress appears, but restraint is slow or absent when conditions improve. Balance sheets expand quickly and contract reluctantly. Emergency measures expire in name but persist in substance. This asymmetry reveals dependence. A system confident in its resilience would tolerate normalization. A system that cannot normalize without disruption has already limited its own choices. Legal and regulatory changes further reinforce this direction. Rules governing liquidity, collateral, and capital are adjusted to prevent recognition of loss rather than to resolve it. Assets are reclassified. Risks are redistributed. What appears as technical refinement is often structural accommodation. The system adapts not to reduce fragility, but to live with it. Behavior responds accordingly. Capital flows toward areas perceived as protected. Savers are pushed into riskier assets to preserve purchasing power. Institutions align strategies around expected intervention rather than underlying fundamentals. Over time, this behavior becomes self-reinforcing. The system does not merely tolerate dependency, it requires it to function. This isn't coincidence. Once reversal threatens widespread disruption, authorities face a binary choice: allow adjustment and risk instability, or manage outcomes and accept long-term distortion. In practice, systems choose management. The result is not immediate collapse, but a gradual shift in how value is preserved and transferred. The most telling sign is narrative control. Language changes. Inflation becomes transitory, then manageable, then reframed. Debt becomes sustainable under new assumptions. Risk becomes a feature to be administered rather than avoided. When the story must constantly adapt to justify continuity, it suggests that underlying conditions are no longer compatible with earlier frameworks. None of this implies imminent failure. Systems can persist in this phase for years. What it implies is constraint. Future outcomes are bounded. Adjustment will occur, but through channels that minimize resistance rather than maximize transparency. The public may not vote on these changes. Markets may not announce them clearly. They will be embedded in policy pricing and legal structure. Understanding the present through this pattern does not require forecasting dates or events. It requires recognizing that once optionality is gone, timing becomes secondary. Direction is set. The remaining question is not whether change will occur, but how it will be distributed, who will bear it, and whether individuals recognize the environment they are operating within before adaptation becomes forced rather than chosen. At this stage, the system no longer moves toward an outcome by choice, but by necessity. The range of possible endings narrows not because decision-makers lack intelligence or awareness, but because prior commitments have already determined the direction of travel. What remains is not uncertainty about whether adjustment will occur, but ambiguity about its form. Once the point of no return has been crossed, restoration becomes a narrative rather than an option. Confidence must be maintained even as purchasing power erodes. Stability must be projected even as flexibility disappears. The system cannot admit constraint without accelerating loss of trust, so it continues forward under the language of control, coordination, and normalization. This isn't coincidence. It is how systems preserve order when correction would threaten legitimacy itself. From here, outcomes follow a familiar logic. Wealth does not vanish evenly, it is redistributed. Obligations are not repudiated openly. They are diluted, restructured, or absorbed over time. Savers pay through erosion rather than confiscation. Risk is transferred quietly from balance sheets to currency holders, from institutions to households, from the future to the present. The adjustment happens, but it is obscured by complexity and spread across years to reduce resistance. Importantly, this phase does not feel like crisis to most participants. Life continues, markets fluctuate, policies are debated, elections are held. What changes is the relationship between effort and preservation. Work no longer guarantees stability. Prudence no longer ensures safety. Traditional signals of security become unreliable because the system's primary objective has shifted from value preservation to continuity. The inevitable conclusion is not collapse in the cinematic sense, It is transformation under constraint. Monetary regimes rarely end with a single event. They fade, mutate, or are replaced through cumulative changes that only later appear obvious. By the time the new structure is acknowledged, adaptation has already occurred by default rather than design. This is why the most consequential decisions in such periods are not made by institutions, but by individuals. Institutions are locked into paths determined by scale and obligation. Individuals still retain choice, but only if they recognize the environment accurately. Acting as if the old rules still apply becomes increasingly costly the longer the system remains in this phase. The point of no return is not a prediction. It is a condition. Once reached, it defines what is possible and what is not. It does not dictate exact timing or specific policy moves, but it constrains outcomes to a narrow corridor shaped by debt incentives and political reality. Ignoring that constraint does not preserve freedom. It merely delays adaptation until it becomes unavoidable. Understanding this does not require pessimism. It requires clarity. Systems under constraint behave differently, reward different strategies, and penalize different assumptions. Recognizing when inevitability has replaced choice is the first step toward navigating such an environment deliberately rather than reactively. What remains then is not the question of whether the system will change, but how prepared individuals are to operate within a structure where adjustment is already underway, whether acknowledged or not. Once inevitability replaces choice, the role of action changes fundamentally. This is no longer about predicting the exact sequence of events or timing the system's visible stress points. It becomes about positioning behavior assets and expectations, so they are aligned with the direction the system is already moving, rather than the one it claims to be maintaining. At this stage, the most dangerous posture is passivity disguised as patience. Many people interpret stability in headlines as safety and continuity in daily life as confirmation that nothing meaningful has shifted. In reality, this is precisely when adjustment is occurring beneath the surface. Systems under constraint do not announce transitions. They execute them quietly through policy drift, regulatory layering, and monetary recalibration that only becomes obvious after the effects are irreversible. The first strategic shift is mental rather than financial. The assumption that past frameworks will protect future outcomes must be abandoned. This includes trust in fixed income instruments to preserve purchasing power reliance on nominal returns, to reflect real gains and belief that diversification alone mitigates systemic risk. When the unit of account itself is being adjusted, traditional risk models fail because they assume the measuring stick remains stable. From there, action becomes a process of reducing exposure to fragility rather than chasing opportunity. Fragility in this context is not volatility. It is dependence on promises that require systemic stability to be honored at full value. Any asset institution or income stream that functions only if confidence remains intact carries asymmetric risk once this stage begins. The downside is structural, while the upside is capped. Conversely, resilience is found in forms of value that are less sensitive to policy discretion and institutional solvency. This does not imply a single solution or asset class, but a shift in criteria. Durability begins to matter more than yield. Control becomes more important than optimization. Liquidity is valued not for convenience, but for optionality under stress. Crucially, timing is no longer about waiting for confirmation. By the time confirmation arrives, adaptation has already been priced in by those closer to the system's mechanics. Once the stage begins, delayed action tends to be reactive rather than strategic, executed under pressure rather than choice. That difference alone often determines whether adjustment is manageable or destructive. This is also the phase where narratives become louder and more polarized. Public messaging emphasizes reassurance, unity, and long-term confidence, precisely because private actors are repositioning defensively. The gap between rhetoric and behavior widens. Observing what large institutions do quietly becomes more informative than listening to what they say publicly. Action, then, is not about dramatic moves. It is about alignment. Aligning expectations with constraint, aligning exposure with durability, aligning strategy with the reality that the system's primary objective is no longer growth or efficiency, but continuity through redistribution. Those who act accordingly preserve flexibility. Those who do not become captive to outcomes they did not choose. By this point, the window for effortless adjustment has closed, but the window for deliberate positioning has not. The difference lies in recognizing that preservation under systemic transition requires different rules than accumulation during expansion. Acting under the old logic in a new phase is not neutral. It is an active risk. The final piece is understanding that preparation is not a single decision, but an ongoing process. As constraints tighten, the system will continue to signal stability while subtly narrowing options. The individuals who remain adaptable are those who treat this phase not as an anomaly, but as a new operating environment requiring a different playbook. The final question is not whether the system will stabilize again, but on whose terms that stability will exist. Every historical transition of this kind ends not with collapse, but with redefinition. The monetary framework survives, institutions persist, and daily life continues. What changes is the distribution of risk control and optionality inside the system. Stability returns only after the transfer is complete. This is why the most consequential outcomes are rarely visible at the peak of crisis. They are locked in during the adjustment phase when rules are rewritten quietly and constraints become normalized. By the time a new equilibrium is publicly acknowledged, the advantage has already shifted. The system does not reward those who waited for clarity. It rewards those who recognized inevitability early enough to reposition before adaptation became mandatory. What follows this phase is not chaos, but consolidation. Power centralizes. Complexity increases. Flexibility decreases. The system becomes more managed, more surveilled, and less tolerant of deviation. Risk is not eliminated, it is concentrated. The appearance of order returns, but the cost of noncompliance rises. At that point, individual leverage depends almost entirely on decisions made during this transitional window. This is why understanding the sequence matters more than predicting headlines. Once the stage is complete, choices narrow dramatically. Policy tools become permanent. Temporary measures are absorbed into baseline operations. What was once framed as emergency response becomes structural design. At that moment, adaptation shifts from proactive to constrained. This isn't coincidence. This pattern has appeared before whenever debt saturation, monetary dilution, and institutional credibility converge. Once the stage begins, reversal does not occur through debate or reform, but through exhaustion of alternatives. The system does not ask for permission to change. It changes, and the participants adjust or absorb the consequences. The purpose of this analysis is not to offer certainty, but to clarify trajectory. When direction is clear, precision becomes less important. Those who understand where the system is heading do not need to predict each step. They need only to avoid positioning themselves against the flow. What comes next is not an endpoint, but a continuation. The mechanisms discussed here do not stop at one market, one policy, or one crisis. They extend outward touching currencies, assets, sovereignty, and personal autonomy in ways that unfold over time. This video ends here, but the sequence does not. In the next chapter, the focus shifts from recognizing the transition to understanding how the next layer of control is built on top of it, and why that construction phase matters even more than the crisis that justified it.